Yo, we are back. We are live. Definitely want to check this out. This guy right here, I don't know. I like his channel, Get Rich Education. I like his channel, but he just posted this 2 hours ago. I gotta watch it because he's saying some crazy stuff. I like stocks. You know, I'm definitely not a stocks hater. I like real estate as well. I do both. But he's talking crazy with stocks right now.
You know, it's a curiosity to me that smart people often think that stocks create wealth. Stick around, and by the end of this video, you'll see me fully reconstruct why stocks don't create wealth for everyday investors. Now, I hope that this won't offend you if you are a stock investing adherent. I mean, we all learn.
For your everyday investor, I mean, you gotta put real money into it. He's not. I'm thinking he's not talking day trading. He's not talking, stock options. That's not as likely. But if you pumping money long term, the type of money you would have to pump into real estate, man, you can make some money, man. I don't know, man. Like right now, everything seems cheap. I've been dollar cost averaging like crazy. I've been pumping in about $4,000 a month into the stock market every single month. Just dollar cost averaging into my favorite companies. So, because everything's so cheap right now. If it stays this cheap or it keeps going down, I keep buying. And by the end of the year, I might have $50,000, $50-something thousand worth of amazingly cheap stocks, and I'll ride the wave up because long term, I don't see how you can't build real wealth in stocks. I don't know, but let's hear him out. Maybe I'm wrong.
And understand and experience the world through different lenses. So I want to share with you the thought paradigm that shifted my own personal journey in understanding this. Major stock indices recently flirted with bear market territory. That means a drop of 20% or more from a recent high. And often it's events like that that give people time to pause and reflect on some things. In fact, the Dow had its 8th consecutive weekly loss. That's the longest such streak since 1923. Misery loves companies, I guess, because big tech shrunk down to medium tech. Even stayed reliable companies like Apple and Walmart and Target are tanking, and they
for no reason. I get it. There is a reason, but those are great companies. You buy them.
Reported disappointing earnings. Now, other than a 1-month flash crash in March of 2020, millennials and Gen Zers have zero experience with a true sustained recession. We haven't had one of those in 13 years, an unusually long period of time. And so perhaps those investors will sell low. Perhaps other ones will stay the course. But there's one simple question that exceedingly few people ever ask themselves. Have I ever actually met anyone where stocks made them wealthy? Like creating wealth by just regular retail investing in stocks. Now, I never have. I've never met one person that's done that. Now, I'm talking about creating wealth. For example, someone that was just getting by or someone that was middle class and they transitioned into wealthy.
You got a little bit of a point there, but I would say you're right. Most people build their wealth from businesses. I wouldn't even say real estate. I would say most people build their wealth from businesses.
Just through savvy and shrewd stock investing. I've never met anyone like that. But now, why not? After all, the S&P 500 has averaged about a 10% annual return over time, and traditional stock advisors will often tell you something like about the rule of 72 and how that should create wealth. You've probably heard of that before. The rule of 72.
You just take like this
72,
normally?
you divide it by your annual percent return, which is 10 in this case, and that result of 7.2 years, that results in the doubling time. Therefore, it should take your money only 7.2 years to double. Well, over decades, with successive doublings, you should have a fantastic retirement and maybe even create wealth. But then why doesn't it? Really, that is due to 5 big drags: inflation, emotion, taxes, fees, and volatility. So let's...
But doesn't don't businesses do well against inflation?
Take your 10% return and subtract all 5 of those drags. Now let's see what kind of return we really end up with after we adjust that return. The first one is inflation. Now a lot of experts agree that the CPI, which is currently over 8%, drastically understates inflation, and that the true diminished purchasing power of the dollar might be something like 15% right now. But let's just use a longer term inflation number of 5%. All right, so you're 10%.
I don't know that I agree with that. Your money's inside of an asset. It's in a business. Businesses typically do well against inflation. So I don't know if I agree with that. And then the next one, taxes. You only pay taxes if you sell. You could always borrow against stocks. It's very easy to borrow against stocks, and there's no taxes against debt. So I don't know.
Your return from the S&P 500 minus 5% inflation, we now have a 5% return after adjusting for just
yeah, I don't agree with that.
Inflation. Now, the next drag is emotion. Well, everyone knows that you're supposed to buy low and sell high. But so many do exactly the opposite thing. Why is that? People actually have a really hard time buying low, because once the price of a stock or an investment has fallen for such a long time, people really don't want to get involved in it. And the predominant emotion there is discouragement. You kind of get bathed in a media bath of reading all of these negative articles, and a lot of people actually sell low rather than buy low because they're just tired of getting up and checking their stocks. And
I don't like that one either, because you can say that about anything. You can say that about any asset class.
Losing money. So we all know we're supposed to buy low, but the human predisposition is actually to sell low. And conversely, why isn't everyone selling high when they're supposed to? Well, it's sort of the opposite emotion. There's this feeling of momentum. Everyone's making money. You just want to continue to ride the momentum. And really the prevailing emotion is euphoria. However, almost everyone believes that they are an above average investor despite the statistical impossibility of that ever happening. And this effect is called illusory superiority. You know, it's a lot like how when people are polled, 7 out of 10 people believe that they're an above average driver. It's the same with stocks. Okay, so we'll just say that this takes one's 5% inflation adjusted return down to 4%, and that is being really kind, only whittling 1% off that emotionally adjusted return. What about taxes and fees? Well, capital gains taxes, they start at 15%, and then they go up from there. Currently, the highest ordinary income tax rate is 37%. Even if funds are sheltered in a 401k or other retirement type plans, oftentimes you do need to begin paying taxes as soon as you retire. And fees vary widely. They're all over the place. So an S&P 500 investor's return after it's adjusted for inflation and emotion and taxes and fees could very well be below 2%. We're just being really kind. We'll just say it's whittled down to 2% now. Again, really conservative here. We're not done. What about the effect of volatility on an S&P 500 investor's return, or just any stock investor's return? And so many people miss this. The rule of 72 and other projections are based on a fixed annual rate of return. It's called the compound annual growth rate. Now, in something like the rule of 72, the assumption that goes into that is that you get exactly a 10% rate of return year after year, just a really smoothed out return. This is irresponsibly quixotic. The real world just does not work this way.
Quixotic.
If you have a 20% loss,
yeah, if I learned anything from this video, it's definitely that word, quixotic.
Then you need a 25% gain just to get back to zero. That's simply math. And if you have a 40% loss, you would need a 66.7% gain following that loss just to get back to even. So using this smooth CAGR, compound annual growth rate, what that does is that it diminishes the damaging effect of this return volatility. And now you can see why rates of return for stock investors are often less than 0%. This whole thing crumbled faster than a Nature Valley granola bar, which actually aren't good for you, by the way.
Yeah, I like his channel, man, especially when it comes to real estate. I'm not agreeing with this at all.
A lot of processed food and sugars in those things. But note that I even really often have been pretty kind here. You know, I even use 10% to start with, something that a lot of stock investors consider to be a good return over time. And you know, this analysis isn't deeply technical and replete with formulas for pinpoint accuracy, but it helps you begin to understand why you rarely, if ever, will meet anyone that ever acquired wealth with these vehicles as a retail investor after adjusting for inflation and emotion and taxes and fees and volatility. And you know, asking around here at GRE a little bit, our content manager said he once knew someone that did acquire wealth from stocks in a way only because his company IPO'd. So he really didn't acquire wealth from doing it on the retail side. Now, about 10 years ago, when I worked for the State Department of Transportation in an 8-foot by 10-foot blue cubicle, you know, I began to realize some things. Investing in retirement plans makes me safe and normal, and I really don't want to live a safe life. I really don't want to live a...
I can't do this no more. I can't do this no more. What I'm gonna do now is let's look at a different point of view. There was a video I was looking at that this guy turned $2,000 into $2 million. It doesn't sound very realistic, but the Dumb Money guys I really like. I love their channel. This thing is mad. It's a long video. Nah, it's too long. I don't know. I've seen a lot of YouTubers that have done it. And I personally know some people that have done it. Obviously they got perfect timing, amazing, you know, with this last cycle that we went through. People with Tesla became millionaires like ASAP. I do think with stocks you can't be too safe, you can't be too conservative. You're gonna be a millionaire in this lifetime investing in stocks. You gotta focus on some great companies that you really like, that you really feel you have conviction in. And like Warren Buffett says, diversity is for idiots. You know, people who don't have a lot of conviction. It's very safe. It makes a lot of sense for them. But if you have conviction in something, if you know a company, man, you pump some money in there. I wish, you know, I always believed in Tesla, and I never had money to put into them until recently. But I would have rolled that wave up, man. Yeah, I don't know how I felt about that video. It makes me want to go back to his like real estate video and poke holes as well, because that was just I don't know. I just feel like that was kind of short-sighted. It wasn't really fair to stocks. It didn't make a lot of that stuff you can apply to real estate as well. All right, guys, that's it for this video. If I find another one, I'll go live on that as well. Y'all have a good one.